Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over ratios. This is going to be all the ratios, give you an update. I usually do this about once a week. You guys get to see how the ratios are changing. If we see any good developments, obviously I'll give you my opinion here on those developments. So let's dive into this. I'll give you my financial opinion. Please don't use this as advice. One quick thing just to touch on ratios. Ratios is an asset divided by another asset compared to history. And we're looking at how these assets interact with each other. We want to buy when the valuation is low and improving. And I'll make comments as we go through that, where I am deploying my money given where the ratios look like. So let's take a look here. I've got the CRB index in relationship to the S&P 500. So this is commodities to stock ratio. In 2008, this is where we peaked. We had this ratio peak. You could see that we had this big wick at the top. The wicks that I'm talking about are all these big wicks at the top here. That usually means you're going through a topping pattern where it tries to run up and then sellers sell it off. Tries to run up, sellers sell off. So people are buying stocks in this type of scenario, not necessarily commodities, because it's showing us that there's a topping process action going on in 2008. Now, we've gone through this pullback here, and we're on the right-hand side, and we've broken the downtrend. That's what this big break is right here. It's a big break through the downtrend. We come back. We've got two small down days, and then another bullish piercing pattern, which is a reversal pattern to the upside on the monthly candlestick. As we zoom into it, you can see we've come on down. We've got this nice little pattern. We've broken to the upside. We've pulled back. And now I think we're ready to go with this bullish hammer pattern on the weekly candlestick basis, signaling that we're probably going to move on up for commodities in relationship to stocks. And remember, stocks can fall, commodities can fall less, and this ratio will still improve. It's on a relative basis. It's saying that commodities will outperform stocks. And this usually this ratio ties in with the real estate market. The real estate market crashed in 2008. Well, I should say it was crashing in 2007, but the realization came in 2008 where prices started to fall. Then this blew out. This was in a recovery phase of real estate all through here. And then we started coming into an expansion phase over in this region, and where this ratio is starting to turn and move on up. What that is signaling is we're going into an inflationary environment. We're seeing that inflation in the numbers all over the place. So it's coming. This is a good spot to be. This ratio is cheap for commodities, and it's improving for commodities. And that's exactly the spot that you would want to be looking at commodities. This is the platinum to gold ratio. What happens here is the ratio peaks usually during an inflationary cycle. And what this is happening is it was basically flatlining on an expensive ratio of 2.26. You get these wicks on the top. These wicks on the top usually indicate that you've got a lot of sellers up here. This is a good spot to be trading for gold at this ratio, your platinum for gold. Now we are at ludicrously low valuations for platinum today. We're at 0.5. If we were to go back to over 2, that means that you're going to get over 4 times your amount of gold when platinum revalues itself. Usually it revalues itself under inflationary conditions. And it's usually at the beginning of a bull market, and although it's sustained higher at the beginning and ends of an inflationary commodities bull market. Last bull market started in 98, and it's really took off in 2000. It peaked, came back and peaked at 2008, did a double top in the ratio against gold. Now we went into a disinflationary recovery phase of real estate, which brought us all the way down here. And right here, I think, is an excellent time to be looking at platinum because the ratio is so incredibly cheap. This is the platinum to palladium ratio. Again, platinum is dirt cheap in relationship to palladium. Back in that 2000-ish, 2001, 2002 timeframe, all the way to 2008, it peaked at over 5.5, which means that 1 ounce of platinum could buy over 5.5 ounces of palladium. If you had bought a bunch of palladium and swapped your platinum here in 2008 and 9 for palladium, you could have rode that all the way down and been swapping in your range right now at 0.5. And if you did it at 5, you would have swapped 10 times your platinum metal. And if you had played the entire move here, where you went from, I'm just going to call it 0.5 to make the math easy, 0.5 to 5, which means that you bought your platinum here, got 10 times your amount of palladium that you could have done instead of buying it here. So you went 10x and then another 10x downward. It's 100 times. So buying here, you get 100. I think that's right. Let's do the calculation here, because that just seems unbelievable to me. So if you own 10 ounces of platinum that you bought here and you rode it all the way up, you would have swapped 10 ounces of platinum times 5, which is palladium. So you have 50 ounces of palladium. Then you come all the way down and you sell it for 0.5, which means you divide it by 0.5. Yep. Or multiply it by 2. You have 100 ounces. So you 10x'd your true purchasing power. And you started with 10 ounces of platinum to 100 ounces of platinum in this rotation. Platinum in the year 2001, I'm just curious to see what it cost. It's going to be something of a low number. $528 is the average closing price. So that's the average. So you would have put in $5,000, and today you'd have over 100 grand. So 100 grand divided by 5, you 20x'd your money. So you 10x'd. What you did is you 10x'd your money, or you 10x'd your ounces, but you 20x'd your dollar value in a 20-year time frame. Absolutely insane. We've got the platinum to silver ratio is incredibly cheap. The year 2003 would have been the year where you would have been swapping at 150 ounces of silver. So one ounce platinum to 150 went all the way down to a bottom of about 30. And now we're coming up back up slowly. Let me move this down here. It's supposed to be like that. And we're about to break, and I think it's going to break to the upside. We'll obviously see what kind of conditions are ahead of us, but I'm thinking that platinum's going to do quite well. We've got gold to silver. Silver's, it's 1 ounce gold to 80 ounces. Put this here. We broke to the downside. We're doing a return move, and then I think we're probably going to crash down. We might hit 83 before the crash lower. Maybe. This is the palladium to silver. This was my swapping scenario that I put on here. You'd be holding silver at the moment, 2,380 ounces from 1 ounce of palladium and 98. God, that's a good deal. And it's contracting lower. The Dow Jones to gold. Looks like we're just barely hanging on here. Let's go to a 1 year. Ooh, nice big bearish engulfing patterns here where we could blow this to the downside, guys. What this is signaling is that we could be going into a gold outperformance at any second here against stocks. And that this is a huge, huge turning point. And I can't emphasize that enough, where when this thing drops, we could see a very large move to the downside, just like we saw in 2000, where gold outperformed and moved all the way down here to a 6 ratio. Then we went into a recovery phase of real estate where stocks do well. And then I think we're coming all the way back down here somewhere. And that happened here with the recovery phase as well in some of these areas. We were coming down and went into a recovery phase, recession recovery phase for real estate in the middle here, and then it came back into a bull market with an expansion phase of real estate. Same thing's going to happen here. It's just a longer time frame. I think we'll come all the way back down to maybe 2 or something like that. Here's the gold to oil ratio. We're in this trend line. We're still in this pattern here. The ratio is at 25.5, which is incredibly cheap for oil. We've seen this ratio compress down all the way to about 6 or 7. And we were coming from the most ridiculous level we've ever seen of 150 and 112. And in looking at history, we've never been this out of balance. Usually this manifests itself with a bunch of supply problems going this cheap because investment pulls back quite dramatically. And what I am suspecting here going forward is a compression in this ratio, a breakout of about 20 to the downside and compressing down below 10, which means oil is going to outperform gold, and it does that during commodity bull markets. Oil is more inflation sensitive than gold is. So the compression under a very highly inflationary environment happens quite dramatically in these types of conditions. And then we've got the copper to gold ratio, and copper's just been moving sideways at the moment. It's right at this top line. It's going sideways, and we'll see a break to the upside eventually and get a huge blow off top against gold, I think, during this commodity bull market. It's just going to take some time. So that's what I've got for today in terms of the ratios. I do think that precious metals, especially platinum, is very cheap. I think commodities are going to do incredibly well. And if we see gold start to outperform the Dow Jones Industrial or gold outperforming the S&P 500, which it looks like it's starting to do, we need to see that break through that line. If we see a break through that line, the paradigm is shifting. That's a big deal because it's going to signal to the market that inflation is here. Gold's going to outperform stocks, and stocks are going to be weak. And most likely, you're going to see an increasing interest rate environment. What is the Fed doing? They are signaling that they are going to taper, and tapering usually means higher rates. So we'll see what happens. Again, subscribe to the channel if you guys want to be updated on this stuff. I go over it on a weekly basis, the ratios. And I am in the inflation camp because of the expansionary phase of real estate and the credit expansion with loans against new homes being built. It's been inflationary in history. I think we're going to repeat history, and it will be inflationary, and it will sustain that inflation. In these market conditions, we usually see higher interest rates because of the inflation. People sell bonds. It puts pressure on interest rates to go up, and it just depends on what the government wants to do and how many bonds they buy to hold interest rates down. If they hold interest rates down and they're successful at doing it with a very large real negative rate, inflation being greater than the interest rate that bonds pay. Usually we use the 10-year bond. If that persists, the dollar will be sacrificed. And you're seeing that happen in other currencies. When they have high inflation rates, they start lowering their interest rate, and then their dollar or their currency goes to garbage. So it's happening in Turkey right now. If you want to follow, they're lowering interest rates in a high inflationary environment, and their currency is getting demolished. So that's what I've got for today. Give me a thumbs up on the content, subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.